Greetings, everyone, and Happy New Year. Well, it was an eventful turn of the year. The government shutdown did end, and here we are. We're catching up with economic statistics. I'm going to be doing something a little different this time instead of the normal drill, because I'd like to give you a preview of a letter that we're going to be putting out. At least show you some of the charts and really go through the line of thinking that we have been processing over the last year, actually over the last 3 years, and then talk a little bit more about the future and how importantly the inflation call is here. So with that, I will start with the rolling recession. We've been talking about the rolling recession. Now, why am I bringing that up again today? Well, we have had a GDP report since the last time I did this webinar, and it showed real GDP growth at more than 4% at an annual rate during the third quarter. That does not sound like a recession at all. And in fact, the GDP Now statistics out of the Atlanta Fed are suggesting the fourth quarter, when it's reported, could be as strong as 5% at an annual rate. So I have to go back and we need to process what we mean by rolling recession. Underneath all of those GDP growth rates, and they've been for the most part positive for the last 3 years, have been some very negative developments. And I know most people know about them because most of us either own a home or are looking for a home or are looking for a cheaper rent. And so housing is top of mind. And here you can see what has happened over the last few years since interest rates took off, that 22-fold jump in the Fed funds rate from 0.25% to 5.5%. And you can see it has really crushed the housing market. I remember when I started in the business, I was in college, it was the late 70s, and interest rates were soaring back then. And I remember the housing market being this low, somewhere in the 4 to 5 million unit range. Now, the interesting thing is the population back then was somewhere in the 215 or 220 million range in the United States. And today we're at 340 million people in the United States. And here we are back at certainly recession levels, almost as bad as the housing crisis itself in 0809, and as low as housing was in the late 70s. Now, I think what's going to happen here, and you'll notice that President Trump has been focused on housing. In the last few days, he has said he's going to do a lot about housing affordability in the next year or so. And I think that's in response to the elections in New York, New Jersey, and Virginia, which were all about affordability. And so last night, the president announced that he would get his representatives to buy $200 billion of mortgage bonds, which increasing the demand for mortgage bonds should drive the interest rate down, or at least that's what he thinks. Now, 200 billion is a very low number relative to the amount of mortgage debt out there in the trillions and trillions of dollars. But nonetheless, that's his first attempt, and we'll see what happens. It hasn't had much of an impact on long-term interest rates today, but let's see what happens. We do believe that housing is getting set up for a significant rebound. And I do believe interest rates are going to be one of the biggest reasons for that rebound, as well as price cuts. And we'll get into that in a moment. Another rolling recession example here is in the manufacturing sector. This is U.S. manufacturing. Anything below 50 is a contraction in manufacturing. 50 is the demarcation point between expansion and contraction. And as you can see, for nearly 3 years, we have seen nothing but contraction here in the US when it comes to manufacturing. So this has been part of the rolling recession, to be sure. And it's very unusual for manufacturing to contract for this long a period of time. Usually short and sharp both ways. But not so this time around. So we do believe the rubber band is stretching for manufacturing to rebound as well during the next year. Here is a leading indicator. Now you can see this is capital spending as measured by non-defense capital goods orders. The top line there, the purple line, is with technology. The green line is without technology. And you can see that the top line, I found this very interesting. Since 2000, we've been in a basing range, it seems, for the top part of the chart here. And whenever we hit that 70 billion mark, we tended to go back down. Well, we've broken out of that, importantly, I think, because of AI and the ChatGPT moment. But you can see before that moment, the non-AI part of this chart on the bottom there was really putting a drag on the total, and only recently has turned back up. We think it's important and significant that this purple line has broken out to all-time highs and is probably going to go a lot higher if our view on capital spending related to AI, including power, is correct. So this has been a leading indicator. It's starting to come out. We're just getting to old highs. And we do think we're going to see a breakout here, which could be quite significant. So the last chart I'll show in terms of illustrating the rolling recession, and I could show a lot more. Anything having to do with small business has had a very tough time over the last 3 years. The last one I'll show is consumer confidence for 3 income categories: high income, middle income, and low income. So this is as measured by the University of Michigan. This index or survey started in the 70s. So I've been watching it my entire career. Something has changed recently, and that is the way they collect the survey data. It used to be person to person or on the phone. Now it is online, and it does seem that there has been a tilting of the survey results towards more Democrats than Republicans. It used to be 50-50. Now I believe it's 70% Democrats and 30% Republicans. So there's a little more bias in this, and I wanted to make sure that everyone understood it. It's not completely apples to apples throughout history here. Nonetheless, you can see how low confidence is. It's as bad now for the lower income categories as it's worse than 08-09. And you have to go back to 1980 when we were at double-digit inflation and interest rates to see sentiment this poor. So the consumer is not in a good mood. And in fact, the most recent numbers show that the consumer still expects elevated inflation. And in fact, it ticked up a bit. in the last couple of months, expectations into the 3 to 4% range. Now, this is a very important call on our part. We do not believe that's going to be the case, and that consumer sentiment will turn around as more and more prices that are important to consumers start coming down. And one of those, well, before I go on to the prices coming down, let me illustrate a few other reasons that the consumer is unhappy. The unemployment rate, the total unemployment rate, looks fairly low if you look at the lowest line there, which is the total. It looks low by historical standards, and it is. But if you look at the black line at the top, you'll see unemployment in the younger generation. Now, I used to refer to this as new college graduates. That was a mistake. And it's really 16 to 24-year-olds. That's the black line. And you can see that unemployment rate. It has been going up for the last 3 years. It is at 12%, which is double digit. And so therefore, while the overall unemployment rate looks fairly tame, the brunt of the recent increase has been borne by the younger generation. And as I have said before, the younger generation is AI native. We don't even say digitally native anymore, AI native. So I'm saying go for it. You see a business that could solve a problem that you see out there, work with ChatGPT or Grok to start your business. I remember when I started my business, I was starting from zero. I had forgotten how to do PowerPoint and everything, and I had to start all over. Now ChatGPT can help you design a business plan, a marketing plan, a sales plan. You just have to have the good idea. So one of the reasons I'm saying that is, and I'll go back to this chart, I'm saying that is because the duration of unemployment is 24 weeks on average. The median duration